Dollar index. I mean, all that stuff on Friday was really interesting, right? You had basically the fallout between relations in the U.S., Ukraine, etc. We'll see if there's some bounce back on that front, but really a lot of uncertainty there. And it seems, I don't know if you saw this over the weekend too. Putin even made like kind of a minerals offer to negotiate with the U.S. For the same kinds of things that the U.S. wants out of Ukraine, right? The minerals deal that the U.S. wants. Putin actually seems to want to negotiate directly with the United States on something like that, which is again a very big shift from where relations were for the last few years. For the last few years, it seems like U.S. really heavily backed its European allies and Ukraine, and now seems to be kind of wanting more out of the negotiation and making harder pushes for ceasefire. We'll see what all happens there. I guess the market's reaction, however, bounce back in gold prices here this overnight or over the weekend. Stocks mixed here a little bit, and as you pointed out, dollar index lower.
There's a lot to the story of Ukraine. I just want to give people a bit of some points to research. Number one is the Budapest Memorandum. America was giving, and US and Europe was giving Ukraine the backing back in '94 that if at the point Ukraine was the third largest nuclear country, would give up them in return of security guarantees. So maybe Europe can now kind of increase its military spending. That's good for European defense stocks. I have seen the Kongsberg Group and Norwegian, by the way, Nammo, they're all having a field day at the moment. So that's kind of where to go at the moment. But what I've said earlier today is it's going to be incredibly volatile next 24 hours. So whatever you do, stay safe.
Yeah, it's a lot of stuff with the whole, Ukraine and Europe and the alliances and how closely tied are they? And it's just, again, it's a dramatic time because you have shifting kind of, I don't think that necessarily, the US and Europe are just straight up at odds at this point, but there's clearly a difference in opinion on how to handle the situation. We saw a lot of European nations kind of coming to the aid of Ukraine more aggressively, and the US kind of saying, look, a deal or no deal. So we'll see. But going to be a volatile week here despite the Ukraine and Russia stuff, simply because we have economic data coming out all over the place. In just a few minutes, we get PMIs, services PMIs are a Wednesday, manufacturing today. S&P 500 has been a chop fest here recently, back and forth. Big spike up on Friday, but again, that's preceded by a massive tank on Thursday. So do you think, Ivan, that this is a dip? Okay, so if you had to make a decision on this, S&P 500 sold off here. Concerns about growth, concerns about Ukraine, concerns about tariffs, all that stuff. A couple seconds to go. Manufacturing PMI numbers. We'll see if this leads to any kind of follow through one way or the other. Initial reaction for stocks is slightly lower. Gold mixed. Bitcoin dropped and then is mixed.
50.3.
With Pulver Alerts, you get access to the complete log of all of Chris Pulver's trades. But who is Chris Pulver? Chris has over 20 years of trading experience, and he's a licensed money manager. He trades all aspects of the market, including Forex, stocks, ETFs and futures, crypto, commodities, and just about everything else. Let's talk more about where you can find these trades. Inside of the A1 Trading Discord, on the left-hand side, you'll find Chris's section. It's broken up into different categories to make it easier to find the trades you're most interested in. Here, you can browse his trading journal, where he shares videos and general market analysis, his indice trades, commodity trades, Forex, stock and options, and his futures trades. All trades come with analysis, including entries and exits, risk to reward, and more. We're very excited for the future of Pulver Alerts, and we hope you are too.
50.3, Ivan says. Okay. So 50.3, I wouldn't say is a bad number, but I also wouldn't say is a great number either. With the market kind of wobbly right now, I mean, look at this. You had high prices too to come with that. So ISM manufacturing prices went up and actual outlook kind of stayed flat to slightly down from forecasts. So not the ideal thing we're looking for to save the day. Dollar index continues to kind of get pummeled here. I actually thought when we gapped open, we'd see a little bit of a fade here, but completely reversed, headed lower here at this time. We'll see.
Yeah, so if you're really going to go into a bit more, manufacturing orders, new orders, was, I would argue, significant, or not even a tad, but significantly lower. It was 55 last time, and I was 48. So that is one, into negative territory, and two, it's more than 7 points lower. Same with employment. So that's a significant lower for manufacturing, though manufacturing is still the most important sector, but still. And then you said prices is much higher, which makes it a bit funny that it's just 50. The overall PMI, 50.3 is just in between, just in a bullish territory, but ever so slightly lower than last time, So it's not a fantastically different number from expectation and last, but it's still in the low 50.
Yep. And anything, really this market wants to see some solid numbers, right? It wants to see something to get us out of this funk of, okay, we're seeing economic data and outlooks for the economy. I don't know if you saw this, Ivan, but the Atlanta Now GDP, which is GDP forecast. So that the Atlanta Fed puts out a GDP Now forecast. It's widely been one of the most accurate at predicting the GDP growth, which is incredibly hard to predict. But the Atlanta Fed's GDP Now has actually been pretty accurate, and it, for the first time since 2022, has been forecasting negative GDP growth in the United States, which is fascinating. It's not been forecasted to be negative by them since, I believe it was July of 2022. And this stuff is, economists have the hardest job in the world to try and predict the future, but it's been more accurate than a lot of the other models out there. So we'll see. I mean, with data like manufacturing PMIs and with services PMIs, you want to see these numbers beating forecasts to give you that cushion of, okay, the U.S. economy is unpredictably good, right? Or unpredictably, stronger than expected. That's a good surprise to the upside. But where we see this number falling today, is that a huge miss? No, but 50.3 doesn't get people riled up and excited. And when you have the market kind of on the edge anyways, it doesn't take much for this market to kind of sell now, ask questions later.
Yeah, it wasn't what I was hoping for. I have to argue that. But yet again, as we're back to 105 on euro, we are back to 127 on pound, and we are back to, not really much more than that, but we are back to 106.6 on dollar. Yeah, okay. Yeah, I argue. For how to understand it, this is still dollar bearishness more than anything. If it was negative as below 50, there would be even more dollar bearishness. I think this is just another, that together with the GDP forecast, is just another reason for dollar to fall. And I think that also argues my case from last week. I think I was mentioning it, where it doesn't really matter what you're doing as long as you do it well, whatever you do. Meaning, like, I shorted euro last week. Almost went to target, by the way. I don't know how many pips that's different, but it's 3 pips different. It doesn't really matter what you do. It's what matters is that you do it well. And so there was both buyers and sellers making profit here. I don't know if those who are buying have been able to get euro at the bottom for that matter, but it's don't give up just because me or you have a certain outlook or view.
Yeah, you know, Ivan, somebody commented on my video on Sunday. I thought this was kind of cool. And I'm sure you get comments like this. There are many people who are watching probably feel this way. There's a lot of people who watch us who trade very differently. But Ivan, your point is great, because at the end of the day, you may not trade exactly like Ivan Durai, or maybe you trade something different. Maybe somebody in the audience is like, oh, I only trade Bitcoin, even though Nick and Ivan don't talk about Bitcoin that much. I trade Bitcoin. Hopefully, as Ivan is pointing out, you're doing whatever you do, just do it really well. There's a marketplace for everything for a reason, right? There's people who make money trading Bitcoin, trading euro, trading dollar, trading whatever. At the end of the day, I totally agree. Do whatever you do it well. And there's nothing is perfect. Nothing is you know, a lot of times people are like, oh, I just trade crypto because it's the easiest, or there's nothing easiest in the market. There's no currency pair that's great for beginners. I get that question all the time, Ivan. People say, which currency pair is easiest for beginners? And I always think in my head, I'm like, well, you let me know if you find it, because I'm just going to trade the beginner's pair. That's what anybody smart would do. There's no beginner, quote unquote, chart.
I'm sure you saw the AAII. You posted that in Edge Finder.
Yes.
One of the most bearish readings I've seen since a actual bear market. Crazy amounts of sentiment swings we've seen this year.
I'm glad you brought that up, because I wanted to discuss that. I also broke it out into 2 other unique charts. I think it can sometimes be a little hard to look at all at once. So I broke it into 2 segments. This is your bullishness. This is your bearishness. As you pointed out, look at the bearish sentiment. So for those who don't know, the AAII Investor Sentiment Survey is a weekly report that shows a huge number of respondents' perspective on the markets. Are they feeling bullish? Are they feeling bearish? Are they feeling neutral? Last week, Ivan was just on. We were discussing this big sell-off that we saw. Now, as you mentioned, Chris, we have 60.6% of respondents saying bearish. I mean, my perspective on that, Chris, is, look, I'm a little cautious on the market myself, but we have to remember this came out, when did that come out? Thursday?
Yep. Worst day. Like Wednesday, Thursday was a terrible plunge, 6 days red. It's like, I understand why the sentiment was deteriorating.
Yeah.
But
so that's my thought is, so guys, this 60.6%, this huge bearish spike in sentiment, when did that occur on the chart? Well, it occurred right here on this big sell-off day. Sure enough, market completely reversed on Friday and has fallen through a little bit here today. But here's you asked me my take on it, Chris. My take on it is, look, if everybody's getting one side of the boat, I want to be cautious all the time. But I also think there's a possibility that we worked off a little bit of that oversold kind of nervousness. And I still remain kind of cautious myself. In fact, I kind of lean bearish in the short run for indices with just everything that's going on. I think longer term, it's a buy the dip opportunity. If we get a sell off down to 5,700, look, I'm going to be accumulating shares on stuff that I like. But what are your thoughts? Different? Same?
No. So I put in a couple of trades that are, well, here's a good example. I just ran an 11-year study, and I just soaked in a bunch of stuff this weekend where it's kind of like rehashing some of the strategies that I typically trade. All I did was I made a couple tweaks to the volatility index, and I ran a study where basically anytime the VIX is over 20, can I sell premium? And should I sell premium? And how do I sell premium? So it's a delta neutral, or a kind of directionally neutral strategy. But with the VIX spiking where it has been up to 20 plus, it usually bodes pretty well for this particular strategy. So I started out this morning selling some premium, where right now out 45 days, it's pretty much like a textbook trade for me. If I go out 45 days, if we're somewhere in between this range, which is about a 7 to 8% swing, I still make money on the trade. So I thought about it this way. When we came into basically 6 days of selling last week, and we had that big rip up on Friday, I thought this was protecting the lows for right now. I mean, everyone is calling this the Trump put over the weekend, which I don't necessarily agree with. I think that Trump is going to be more vocal about the markets if they start to fall. I mean, case in point would be if we did make some fresh lows, President Trump will be vocal. I said this for the last month or so. I see this market this year as you've got, let's say the market's just driving along. I feel like Chris Farley and Tommy Boy when he's on that guy's desk and he's just like, bah, 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 bah. But the market's just riding along and you have a guardrail and a guardrail. So the market's, swerving around and doing its thing, but you've got equities on one side, bonds on the other side. As long as nothing breaks, this market's just going to keep humming along. We're going to still have tariff threats. We're going to have these bargaining chips. You're going to see random tweets and just noise, right? It's a lot of noise. The market, I don't think could all of a sudden flip and say like, we're excited, we're going to all-time highs, because nothing really changed. All we did was have terrible bearish sentiment. That's a contrarian signal, but it doesn't mean that everybody has to jump in and load back up and be buying, because if we do that, we'll go right back up and hitting all-time highs, and it's going to be too bullish and the market's going to flip again. So, but again, I mean, this could all change with like tariffs could be kicked down the road. This 10% tariff in China could be like, it's 10%. Who cares? 25% could be delayed in Europe or delayed in Mexico and Canada. Who knows? Everything's supposed to be going into effect right now, but it pretty much put a floor in the way I see. We filled the election gap on the S&P. We're using this pretty strong support level. It was also right down to the same low on Friday. I wasn't surprised to see that move like intraday. It was a crazy end of the month. And usually February kind of like shrugs off all of the flows. Like big leaps are expiring in December and January. There's a lot of option expirations in that December to January cycle. And so February is usually like, okay, what do we reassess? And so Mag 7 has been a big reason the market's been down. Nvidia crushed earnings, but it wasn't enough, right? Because it's like slowing the trend, and its crushitude, it's slowing the trend, right? It's not exponentially. It's like the law of big numbers. Is it easier to make $1 billion to $2 billion or $100 billion to $200 billion? Well, it's obviously a lot harder to make $200 billion.
Yeah. So, Chris, correct me if I'm wrong. It sounds like you're actually kind of in the same camp as I am in terms of, sounds like, well, based on your positioning, that you're a little bit geared up for a range-bound type of environment. And I actually feel pretty strongly that there's some good kind of cushion to both sides as you're talking about.
Yep.
And that, I think we could see lower prices, but I also see that there's probably big buy the dip, kind of movements out there. I think people sometimes will hear that and they say, well, you're just saying it could go both directions. And that is kind of what we're saying. But there's that clause of we see limited room in either direction. Is that kind of what you're thinking?
Yeah, I think limited room because it's not necessarily so bearish. And I'll say this, until we start to see cracks in the spread market, until I start to see like junk bonds, AAA, BCs, high yield, like if the credit spreads, which are as low as they've been since like 2007, which can be scary because we obviously know what happened in 2008. But until we start to see this market cracking, I think what we're experiencing right now is what needed to happen. I don't know if I can show a leverage ETF. This is probably just, everything's, what I'm saying? Like, I want to get a reading of like, I'll try to find this, but there has to be it's another kind of sentiment indicator. But if you see that like everyone that's in loaded up like leverage ETFs or leverage instruments is now getting hit harder, like that type of trader has to get beat up. And that type of trader that's experienced a 4% or 5% flush that's now down 10, 15, 20%, that's the type of trader that like runs for safety, right? Yeah. And so I think this 4 to 5% correction we've seen in the markets is being it's being displayed like it's so much worse than it actually is. Like the index itself, I mean, to get a bearish sentiment reading that high, Nick, at a 4%, 5% correction is insane to me. But it just shows how much people are concentrating in Mag 7, concentrating in tech, concentrating in leveraged instruments, and that needs to get cleaned up. Like that's all this really is, in my opinion. So I'm not really bullish or bearish. I'm still trading with like this cautiously optimistic outlook, which is I'm building a lot of trades for this environment. If we have prices, navigating in here, that's fine. I'd still like, and you and I talked about this offline last week, but I'd still like to see maybe this market find this 200 moving average.
Yep.
And then I start to get more position for a bullish rally. Now that rally to me is really no better than going back to the all-time highs. In fact, that's probably what my plan is this year. So if I can time this market well enough where an entry into this area that gets back to all-time highs, I'm going to try to make, without obviously risking everything, I'm just going to make a decent amount of capital and be happy, and also be protecting a lot of profit up there, because I don't know how this market necessarily goes 10, 20% higher than the all-time highs. There's just too much uncertainty and a lot of crap that can still happen in 2025 that's not that great.
You mentioned the 200-day moving average, and that, I guess, kind of sums up my thought here, is that if I look at this chart, first of all, I actually didn't realize how close we are now to the 200-day moving average. We did the old correct sideways. That is the most nice way of saying, a pullback, right? We've corrected sideways, quote unquote, because this market has gone sideways for a while, giving the moving averages a chance to catch up. My thought is that, you know what? I buy a 200-day moving average retest, but I also think in the short run, I think we're very likely to go test that, right? So, like I said, Chris, I was mentioning this to Ivan, is over the weekend, I put together some videos sharing my thoughts, and a lot of people were on like, Nick, you're so bearish right now. And there is a difference between being outright bearish, which I think means you think it's going to break that 200-day and start seriously trending down, or what I actually would say is more just, as we always say on the channel, cautiously optimistic or cautiously bullish, which is this idea, look, markets have rolled over here a little bit. We aren't seeing this same every single day up by the dip every single time it happens. We're seeing dips sustain. We're seeing, for the first time, I would argue, for a little while, we've corrected sideways. Is it out of the question for this market to have one or two more kind of moves lower to test some long overdue areas to retest? No, I'm actually so bullish that I want prices, as you just pointed out, to work off some of this noise, some of this leverage, some of this over enthusiasm in this market. And then I think we push higher. Like, I think that the bigger theme is the bull run continues, but we need to have our 2023 10% correction, really reload the excitement about equities, and then we can push higher. But I think that when we've run for so long, we've stretched so far without any sort of good give back, flush out, if you will. It's like you got to take out the trash every once in a while and shake out the weak hands and let the diamond hand kind of people do their thing. So I think the 200-day moving average is a pretty fair assessment, in my opinion, of where I think we will test. But hey, just because I think that doesn't mean we have to. If we start breaking structure, start breaking out again, look, I'm not smarter than the market. I don't claim to be, right? I'm trading the trends. I'm looking for opportunities. I think most likely we head back and we test areas. Could be a little ugly in the short run, but I think it gives us a chance to work off some overbought readings and to work off some of that leveraged. And if somebody's down 25% in their portfolio, Chris, my question to them is what are you doing right now? If you're down 25% in a I'm not talking a trading account, I'm talking more like a portfolio. If you're in all the Palantirs, the Coinbase, the Bitcoin, the Ethereum, and your account's down 25%, hopefully this is a wake-up call. It happens every single generation of traders, right? I mean, you get a flush out and it humbles people and they're like, okay, I'm not doing that again. But you have to have those flush outs for people to learn their lesson, and for this bull rally, in my opinion, to actually sustain itself long-term. We want healthy corrections to recalibrate and to go higher on good bearings that aren't so leveraged and so risky.
Agree. Let me ask you this. Let's look out a little bit further in the future. Let's say that we do see all-time highs again tested, let's say in the next 3 to 6 months. How much more bullish are you on the market for 2025 going into 2026? Just bullish or bearish? Like, do you think we sustain a bull market to the tune of another 10, 15%? We just came off of 20% years. Going to a third year of like, do we get a 15 to 20% rally this year?
So, the thing is, Chris, I think I have to default to what I know, which is I want to watch the sentiment indicators that we talk about so frequently. I want to watch the macro. If we rip through the highs, and it's because, the Atlanta Fed GDP now, I don't know if you saw that, actually signaled for the first time since 2022, negative GDP growth expectancy. So, those types of things, if you're hitting all-time highs with macro, which I would say is not bad, but not the kind of overheating, excellent economy kind of outlook that we've had the last few years, if that's cooling and you're hitting all-time highs in price, I would argue that in that case, you might be seeing a divergence between the economy and stock market where I wouldn't trust that rally.
Right.
That's my opinion.
Yep. And also the thing to keep an eye on would be just labor data coming in later this year. Look, we have layoffs in tech. We're starting to see layoffs go into other companies. We've got a huge, massive layoff that's just happened in the federal government. So it's just been an interesting, the market is still navigating all that, right? Like we basically chainsaw the federal government to, I'm trying to think, I listened to this over the weekend and so let's say that Trump and Elon Musk with Doge, instead of just like finding budget items to fix and repair, they just fire people. But if we did that for the entire year and Doge cuts 500,000 federal jobs or 800,000 federal jobs, all that's really doing is just taking back everything that the Biden administration did for the last year. It's just like all the fluffy federal jobs that were a huge point of growth, like growth last year in jobs, government, healthcare, and services industry. That's it. So if we gut a third of that or more so, because there's probably more government jobs than anything else the last couple of years. I don't know what that looks like as far as like overall, state of the economy. I think, like you said, that's the divergence between Wall Street says one thing, Main Street shows another thing. And then on top of that, you layer in, we talked about this last week, the consumer that is still spending money is the higher end earner. Yes. Right? Like 50% of all spending right now is done by the top 10%. You go to the top 20% of demographics. So whoever is the top 20% of earners, that's about 60% of all spending in the country. So if that demographic is hurt, where and here's how they're going to be hurt: the stock market drops, that segment is hurt more. Because those, what is the top 10% now own like 87% of stocks or something ridiculous like that?
They're the ones that have portfolios, period.
Exactly. So they, as far as like where they spend money, what they're spending money on, when they spend money, it will completely be associated and correlated to what this stock market is doing. If we're continuing to stay near all-time highs, consumers healthy, people that have, most of the country right now is sitting like, I think 70+% of mortgages are all like 6% or less or 5% or less or 4% or less. Like it's crazy how low mortgages are in the country.
I gotta tell you a quick story, Chris, because it goes with what you were just saying. In college, one of my really close friends, we traded stocks, invested in stocks together all the time. We talk about, different companies. He was so funny because we had a certain class together, and he would come to the class or not show up to the class based on what stocks were doing that day. And I don't even know if he was consciously doing it, but it plays into exactly what you're saying, because if the stock market was up that day, there's a good chance he would just skip the class. And if the stock market was down, he would come in. He wasn't doing it on purpose, but I told him about it and he's like, oh my gosh, I do that. And that is exactly what you're pointing out. When portfolios are up, people feel good, they spend more, they're less scared. In his case, when portfolio was up, he's like, I don't need school. And when it was down, he's like, I need school. But I thought it was a good comparison to what you're pointing out is, look, people have a portfolio up or down feeling that they carry with them in their spending. And so especially that upper echelon of consumers, if they're feeling good, if their portfolios are all screaming higher, they're going to go on vacation. They're going to go buy a second house. They're going to go buy a car. They're going to go put money down on something. So it's really a really powerful force. Is if stock markets are up or down, it causes sentiment to go up or down with it at the most critical level of the consumer.
Yeah, and I think that what we're going to see sentiment-wise is we're going to see more extremes. And honestly, with Trump as president, this administration, I'd say extremes are probably maybe noisier and overstated than what they really will be, which is why over the weekend I was running the test of like, okay, look, if this VIX, in 2022, we had a bear market in 2022. Everybody felt it. It wasn't the easiest market to trade, but it also came with some pretty nice bounces, right? We had a flush down, then a bounce, 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 flush down again. And then we actually established that it was a 9-month bear market because we're making lower highs and lower lows. But if you were timing this, like every flush down was met with a pretty nice rally. And so I think over the next, let's say 30 to 60 days, let's just say 30 days, if we actually see the market, stabilize off of those lows from February, literally like February 28th is a good reference point. If we stabilize off those lows, that's fine. But we don't necessarily break the highs. We don't necessarily flush lower. And there's a lot of option trading that can be done when you have higher volatility, selling that premium. The actual move is far less than the expected move because volatility is so much higher, right? When the VIX is higher and you're selling premium, you're typically taking advantage of that difference between the expected move, which is usually overstated, and the actual move, which is going to be much less, which is why that's exactly what I did this morning, which is sell a bunch of premium. And that's what I'm going to continue to do. And it's all going to be risk defined. I mean, I know that if you're thinking selling premium, like just sell a bunch of puts and just do strangles and sell, it's all defined risk for me. I know, because that way, if there is an
Iron
outlier,
condors and things like that.
yeah, like iron condors,
Dollars.
and I do like synthetics where it's like a little bit wider. So like a 20 wide or 30 wide iron condor is almost treated like a strangle as far as the credit you receive. So instead of getting $5 of credit, I get $4.20 of credit. And so I'll sacrifice the 80 cents, but it treats it much the same way. And if we have an outlier event, I'm not stuck with that like crazy undefined risk that and I see too many equity curves that happens to, right? You can do everything right for months and months and months and make all this consistent income, and then one July to August, like we had last year, then all of a sudden people's accounts look like that.
Yep.
Because of undefined risk. And so if I can cap that undefined risk, it's like, look, I'll risk, $1,000 here, a couple $1,000 here, and that's the worst I can lose. That's a lot better off than like, oh my God, I'm down, 3, 4, 500% on my puts.
For that outlier VIX move. Yeah.
Exactly. For that outlier. And speaking of that, I mean, that's what last year was. If I'm taking anything away from last year, it was, I know the market was a bull market. I know we had hiccup in April, in August, and briefly right after Labor Day, and then December was no picnic and it wasn't a Santa rally. But that showed us how sensitive this market has become when it's like VIX events. We had 2 of the largest VIX single day moves ever. And on top of that, right now, Nick, this is one thing that does make me a little bit nervous going into the next, let's say 12 months or so, is there are so many instruments now that traders can trade that I'm not saying this is going to ruin liquidity, but it does make me nervous when everyone is trading. And I'm putting everyone in like light terms here, but everybody could, if they wanted to, trade just leverage instruments. Everybody. And so instead of trading the SPY, what if you traded always XX leverage? And instead of trading Nvidia all by itself, what if you just traded XX Nvidia? Instead of Bitcoin, you traded XX, or MicroStrategy traded it's like, that's crazy to me that just trade the underlying, which is already crazy enough. Like Bitcoin's already volatile enough. MicroStrategy is already crazy enough. Nvidia is already going to be crazy enough. But when people are just going into leverage instruments, I just think that it's like that flow on the peripherals, and the flow is all those extra derivatives makes it where there's not really liquidity everywhere if it's being spread out like over all these other layered instruments. Does that make sense?
Yeah, no, it does.
So, but at some point they're going to get busted up. Like levered anything it works for you and works against you. And I think that's the one part about this year that's going to be so challenging is everyone that's levered looking for direction is probably going to lose. I don't see this market giving us a ton of clear direction, and that's how I'm trading. That's what it sounds like you're trading, and I'd rather take advantage of a trader's market that's not really giving us any direction. And this is again kind of a testament of like, who's traded through stuff like this before? Because I have, and you've seen booms and busts in the last 6+ years. You've been trading for almost 10 years, right? So I mean, we've seen a lot, and I know that the market doesn't have to always go directionally up, directionally down. The market this year could be so uncertain about where it wants to go, where it can go, that it's going to be like a 2015, 2016. We're going to have like these maybe 10, 15% swings. And, when we come to like an extreme low, it's like sentiment's going to blast all these readings and everyone's bearish and it's a buy signal. And then it goes too high and it's like, we can't really justify these valuations. It's going to be sell signal. This American exceptionalism or this exuberance that America has experienced, like we've had the best market for a decade. We've been outpacing Europe by 3 standard deviations. Well, look at how assets are performing this year. Non-US is kicking the crap out of US right now.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.